Welcome to Investors Insight, where today's topic is earnings blowout. So a lot going on. Trey and Ty are actually back from attending the annual Berkshire Hathaway shareholders meeting in Omaha, Nebraska this past weekend. For compliance reasons, we cannot share the details, but they learned a lot about what's going on in the market. So it's good to have them back in the office this morning. So a lot to talk about today. Before I talk about earnings blowout in the technology sector, and Ty's going to cover GDP update and then also jobless claims. But first, Trey, you have an important update on the Fed. We talk about it. The Fed matters. Talk about that.
Yeah, Bobby. So thank you. Yeah, so we knew that the meeting last week with the Federal Reserve Open Market Committee was going to be Jerome's last as a chairman, and we didn't expect a lot of news to come out of it. But there were two big news items that did kind of move markets and are going to continue to move markets going forward. And one of them is that Jerome Powell, while he is stepping down as chairman, he's not leaving the Fed. And that's very uncommon. Usually the chairman steps down and then leaves the board of governors because it's weird to have, a lame duck or a former chairman there, but he's staying on for personal and legal reasons, which aren't market impactful. It's just impactful to have a former Fed chairman on the Fed. That, so interesting to see how that goes in terms of votes and in terms of how loud a voice Jerome Powell has in the meantime and once Kevin Walsh gets on there. The second big news item was that there were 4 dissents, which is a large amount of dissents. Only 12 members vote, so 4 out of 12 dissenting. Historically, you can see on this chart, this shows the percentage of dissent votes on the Fed per year. And so far this year, we've had 19% of votes have been dissents, and that's a high number. But in the market takes that as a bad thing. But a counterpoint for us is that that's really not a bad thing. Dissent and actually is a good thing because you can flesh out some ideas. So I take this as a positive that we're going to get more open debate from the Fed. I've had many meetings with economists. I've never seen 12 agree on anything, much less economic policy. So the fact that we have historically had unanimous decisions always seemed a little off to me and many economists. And so I think it'll be healthy as we move through changing the Fed chairman and also a change in policy. I think it'll be healthy to hear multiple sides. I think a lot of Supreme Court decisions, the losing side, the dissenting side of the Supreme Court, really also were able to put out their opinions, and that set legal precedent going forward. I think that's healthy to hear what both sides have. So this higher level dissent shows some little uncertainty, but that's probably healthy because we live in uncertain times, and markets really shouldn't take things as so black or white from the Fed. I think it'll be good to hear both sides of decision-making process going forward. So 2 big news items that I think will change the way we view the Fed in the coming months and quarters that will provide, hopefully, more clarity and more discussion around what the decisions are. So should be an interesting time at the Fed, at least for us followers.
Yep, the Fed matters. What also matters is corporate earnings. And so a few weeks ago, we talked about the importance that this corporate earnings season is to the market in order for the market to get back on track from the negative news about what's going on in the Middle East and also higher oil prices. Well, earnings season was impressive last week. And more importantly, the technology sector helped the S&P 500 go higher after a few of the large cap tech names reported really strong earnings. So before the debate about whether investment in AI will pay off is settled, we think the massive AI investments will translate into technology companies' earnings. So we also expect productivity enhancements to drive higher profit margins and support other strong earnings. So simply put, the potential earnings growth is pretty remarkable here. As shown in this chart, in the first quarter, by the time all results are in, technology sector earnings growth may exceed 50% and end up more than 5 times the pace of earnings growth for the rest of the S&P 500. Perhaps even more impressive is the fact that the consensus 2026 earnings estimate for the sector has been revised higher by nearly 15 percentage points, basically as capital investment targets increased. And so if technology companies can execute on current plans and the economy continues to expand as we expect, the sector appears well positioned to sustain outsized earnings growth and continue to drive higher returns for the sector and the overall market. So far, so good. As corporate earnings season continues, as always, no guarantees, but a strong earnings season might help lower the volatility seen in midterm election years. So as we always say, earnings matter. So Ty, give us an update on GDP, and then also we had a really good jobless claims update. Talk about that.
Yeah, so we had our initial Q1 GDP number release. And if you remember back, if you were able to attend our Investors Insights presentation near the beginning of the year, we talked about trying to get back to that 2.5% real GDP number, a productivity number. And so for Q1, we are at 2% for real GDP, that is after inflation. So the nominal GDP number was about 5.6, estimate inflation around 3.2, 3.6, I suppose, in this regard. And so you get that real 2% GDP number. One thing that's been consistent, as you can see in this chart of a breakdown of all the contributors to GDP. Consumer spending has been strong throughout, which is great. The consumer makes up 70% of our economy, so you want to see that. You want to continue to see that be strong. Housing has been a continuous detractor a little bit. And then, of course, with everything going on with government shutdowns and trade policy, inventories, net exports, and government have really been up and down both ways and hard to get a read on, been very volatile. But on top of that, the other thing that was kind of eye-catching was the initial jobless claims number. Now, of course, this can be revised, but it fell to 189,000 this week. And, that number on the surface, I understand, doesn't, seem out of line or anything like that, but it's actually the lowest number since 1969. Now, we're not adjusting for the size of the population, just as a head count, which is really impressive. One of the Fed's mandates or a dual mandate, so, inflation and then unemployment. And so we seem to be doing well on the employment side with initial jobless claims down. Of course, still trying to get our hands around inflation. So overall, pretty strong report. And I think that, the stock market and the economy took it in stride. And we continue to hopefully see how, everything going on in the Middle East and rising oil prices will affect Q2.
Yeah, so again, a lot to cover. We're watching the Fed. We're watching to see if corporate earnings continues to have blowout reports, and then obviously watching everything involved with the economy. So if you have questions on anything we've discussed, call us, email us, come see us. We love to see you and talk to you. Thanks for watching.